Hello, Adrian Ashton here with tutorial 3 on the Social Enterprise Specialism course. This tutorial is considering the aspect of finance, budgeting, and money and accounts, subjects which for many people will fill them with dread because the thought of doing accounts is really scary. The thought of budgeting for an enterprise or a business is similarly daunting. If we'd rather throw it all at a bookkeeper or an accountant to take care of it. And as a result, social enterprises can often get into difficulty financially without realizing it. They can underperform. They can start to become unsustainable very quickly. They can lose the ability to generate the trading surpluses that they need to continue to better address the need that they were set up to create and to continue profitably into the future. So, a couple of things by way of introduction in this recorded video link before you get into the texts and the activities and the links and the materials in the tutorials. So firstly, let's kind of debunk some philosophies, really, some ideas. So the first of which I want to debunk is the philosophy of do what you love. So this often comes about, I see a lot in startup communities, books on how to set up a business, live a better life. And it goes something like this. Do what you love and the money will come. Do what you love and customers will come. Spread the love and the universe will repay you. It seems to be the gist of it. It doesn't work that way, I'm afraid. Do what you love and you'll probably have to work very hard at making sure it can generate an income, sales for the enterprise, and then enough trading surpluses to help you sustain an income for yourself as well within it. That's not to say it's hard work should put you off. Very often it's more fulfilling. People, social entrepreneurs who set up social enterprises say they couldn't imagine, however hard it is, they couldn't imagine going back to working in another type of private company now or in the future. So do what you love and the money will come. Doesn't really work that way. You need to have a viable trading proposition. That goes back to one of the previous tutorials where we were looking at the idea of a feasibility study. Now, so within thinking about finance, within this particular module or this tutorial part of the session, the parts of the social business model canvas we're looking at particularly are the bottom boxes about revenue, about how money comes in. So one of those will be pretty obvious. Well, we're going to trade. It'll be a retail, it'll be a contract, but also as the enterprise sets up, as it grows, it may need to have additional investments of cash. And that's for a number of reasons. Number one is when a new enterprise is starting up, it's going to be spending out more money than it receives coming in because it's setting up. It's taking on premises, it's buying equipment and stock, it's undertaking advertising, it's taking on phone contracts, it's having launch parties, and there aren't enough customers yet coming in and paying to cover those costs fully. So it needs to have kind of what's called working capital. Okay, so sort of working capital says this is the money that we need to tide us over until the customers' payments start coming in. And part of budgeting in your enterprise or any social enterprise or any private enterprise is crucial for this. When it's setting up, how much is it going to need to set itself up, to launch itself? Not just for that first day, but then for those first few months while the trading starts to build up. And budgeting over a cash flow forecast says, how long is it going to take for us to reach that tipping point when we get enough customers, enough trading that the bills are covered, that we can pay our way properly? Now, this all sounds a bit technical, a bit scary, but we've all done it before. As students, when you've taken on student loans or have a household budget to administer, or when you've been in a salaried job and had a paycheck, you've thought about, well, okay, I've got a holiday coming up this year. I want to make sure I've got enough money for that. Christmas is coming. I need to make sure I've got enough money to buy the presents for the family and the kids and other people when it's ready. So we start to do budgeting almost subconsciously all the time in our own personal lives. In a social enterprise, it's just the same. We just make it a bit more formalized. We use a spreadsheet or a piece of software or the back of an envelope just to start to chart out when do we think we're going to need to spend money and on what things, And when do we think money's going to come in against that to help us pay those bills? And where there's a gap, where there's more money going out than coming in, that's where we need to think about raising finance or investment. So there's different ways to approach this idea of raising finance or investment. And traditionally, many social enterprises, if we look at the research, rely on grant funding to do this. And that's okay. Grants are there, grants are fine. Private businesses take grants all the time. Research and development tax credits, for example. Business rate relief is another form of grant. However, grants do have a few problems with them, I would suggest, which says just think twice before you take them. Number one, grants are not quick. My general rule of thumb is if you're applying for a grant, from the date you submit it to when you receive it, if you're going to receive it, because generally speaking, it seems that across the board, grants have about a 15% success rate. Grants are only 1 in 10, about 1 in 10 of all grant applications that are submitted by charities and social enterprises are awarded. So it's really competitive. So if you're going to get that money, from the date you submit to the date you get it, allow about 3 months. So that's problem number one with grants. They're not quick. Problem number two, they're very restrictive. You become handcuffed, you become shackled. Because when you apply for a grant, you say, these are the things we will do, and this is how we will spend the money, and the ways and the things we will use to buy with the money. But you've had that 3-month gap, and things may change. And if you find actually in that intervening period, the way we need to deliver this has changed, or the way that we need to spend the money has changed, we can't automatically do that. If we'd borrowed money as a bank loan, say, or an overdraft, we can spend the money as we need to. We can be very flexible. With a grant, we are more restrained and constricted. So that's problem number two. Problem number one, it's slow. Problem number two, it's very restrictive and prescriptive in how we can spend it. Problem number three is the paperwork and the reporting. If we've borrowed money as a social enterprise through some type of loan or investment to be repaid, then as a general rule of thumb, every month or every few months, whoever lent us the money, the bank manager or someone else, will say, can you please give us an update? Share with us your management accounts, how the money's been coming in and out over the last few months. Now, that's something which any enterprise, a social enterprise, would be doing anyway. So it's not going to be a big hassle. If it's taken a grant, it has to do additional reporting, monitoring, case files, evidences, copies of receipts. There's a lot more paperwork and administration involved. That's problem number three. It's more hassle to manage that grant once you've got it than a straightforward investment or loan would have been. And problem number four, and this is the taboo subject that no one in social enterprise land likes to talk about or admit to. And that's the thing called clawback. Clawback is the phrase that's used when a grant funder feels that you, as the social enterprise who received a grant from them, have not held up your end of the bargain. Now, by that could simply be you've not spent the money in the way that you told them you would, or they'd agreed you could. Or it could be that you've not kept the paperwork up to date in terms of what they needed you to record and to evidence and to provide documents and pictures about. You've not done that. So you can't prove to them, to their satisfaction, that you've delivered what you said you would in the grant application. And in which case, they activate something called clawback. And clawback says, unless you can resolve it with them, you are legally required to repay to that grant-making body the grant that they gave you. But you've already spent it. But it doesn't matter. You've got to find the money to pay it back. But how are we going to raise the money? Because we spent it and it was a grant. Doesn't matter. You've got to pay the money back. So if clawback happens, you only really have one of two choices as a social enterprise. Option one is to use your reserves or to borrow money from somewhere else. And usually it comes down to the founders putting their hands in their own personal pocket and shelling out themselves. More commonplace is option two. The social enterprise is wound up. It's dissolved, it's shut down, it's killed off, and that makes it go away. Neither option is very attractive, and all because social enterprises applying for grants did not think through the full implications of that type of finance. So what we're going to do as we go through this tutorial is to start to explore this idea of budgeting. How do you work out how much you need? Also, pricing. As a social enterprise, you're trading, you are offering a product or service to customers. How do you decide what the right price is for those customers? Do you base it on what other people are charging because that feels about right, but then that may not be enough for what you need to cover your costs with? Do you decide actually what we will do because we're a social enterprise, we're not driven by profits, we can be cheaper, we can undercut private firms? Well, there's a problem with that because generally speaking, if you're cheaper, customers may not think you're that good. It will be devalued. And case in point of that is pound shops. Anyone who's ever been to a pound shop, you never expect what you buy from them to be of a durable quality or of good value. It's a bit of fun and whimsy in the main. So you're devaluing the impact and the benefit of your social enterprise in the eyes of others. Ideally, in terms of pricing, what you're looking for is you've understood the need properly. You've gone to that customer and you said, you have this crucial need. You need to reach a group of people. You need to improve the health or the education of this group of people, and you're really struggling to. We can help you fix that. We can take away your pain. The value of that to the customer suddenly starts to go up. So you can charge more accordingly. So there's different ways to think about how you price in terms of your margins within a social enterprise as well. Remember, it's a social enterprise. Enterprise, it has to trade. Trading an enterprise means needing to create an ongoing surplus. Call it profit, call it creating surplus, doesn't really matter. What it means is you've got money left over at the end of the year through your trading position. You can choose to reinvest that. And again, if we think back to previous tutorials, that's one of the key defining characteristics of a social enterprise. The majority of profits are reinvested against that social purpose, that social need. But you have to have profits to do that. If you say, oh, we're a not-for-profit, that's quite a binary statement. We're not for profit. That must mean we are for loss. So it's not a real business model. It's not trading sustainably. Social enterprises should always be aiming and budgeting and setting margins in the hope of generating a profit. Otherwise, it's not a sustainable enterprise. It becomes a charity because it's always reliant upon grant and philanthropy to bail it out. So if that's the case, call it what it is. Don't be ashamed of that. But it causes confusion otherwise. So financing as well. So within this tutorial, think about the need to trade, think about the need for pricing and how you set your price. Think about how much you might need as well as a social enterprise. How does a social enterprise work out? How much it needs to raise and when? And then within the detail of this tutorial as well, we will also look at some of the different investment options that are available. So social enterprises are enterprises just like any other business. They can go to a bank and get an overdraft or a loan. It's no problem. Many do because it's quite straightforward and simple. But there are other options that social enterprises can avail themselves of. Crowdfunding, for example, is a very popular choice with many, even though the research shows it's really, 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 really hard to raise your funding target. And it's much more effort than you think. There's also this thing called not crowdfunding, we just covered that. This thing called social investment. It's bandied about a lot. Why doesn't a social enterprise take on social investment? A social investment is a loan. It's just from a non-traditional high street bank. It's a loan which is lent to the social enterprise in the expectation that it will help the enterprise to generate more impact. A traditional bank loan lends to the social enterprise to say, this helps you grow, get along, and you can pay your money back. A social investor says, here's the money to help you get along and grow, and we want it back, but we also want to see that this money is being used for social good. It's creating impact and value that way. There's other things that get talked about in terms of social investment and financing for social enterprises, including the idea of what are called social impact bonds. Social impact bonds are a relatively new concept, and they only really apply where you are delivering a public sector contract. Public sector contracts say increasingly we pay by results. So the social enterprise wins the contract to deliver the work, and at the end of the contract, if it's achieved the target aims, it gets paid the full amount. But how does it cash flow itself in between? Where's the working capital to pay the bills and to get to the endpoint? So a social impact bond is a mechanism that says the social enterprise can go to private investors and go, look, we've got this government contract that says in a year's time, when we achieve our targets, we're going to get paid all this money. We've done our budgeting. We've worked out how much we need to deliver the service, and there's a margin. So if you lend us the money now as an impact bond, then in a year's time, when we've delivered it, we've achieved it all, and we get the money from government in respect to that contract, we'll pay you back what you've lent us to deliver it, and then that margin that we made on it, we'll split that margin between us. So that's kind of where social impact bonds work out. But there's a whole plethora of other options, and within the tutorial, we'll start to explore some of those. And we'll also start to put in some further reading so you can dig into those as case studies and applied further as well. Because there is a lot of confusion about this idea about different ways of financing a social enterprise. Ultimately, as well, it's about getting a handle on this. Because the big concern, in my experience of working across the sector for the last however many decades now, is many people involved in social enterprise shy away from the financing, from the accounts, from the budgeting. And it's always for the same reason. It's because they don't think they're any good at maths. And that's a real shame. And I think that's the problem, because all of us are good at maths. Budgeting in a social enterprise, doing the accounts in a social enterprise, working out the margins in a social enterprise only requires us to do basic maths. The sorts of maths we do every day in how we manage our personal finances or our household budgets. The reason that we don't think we're any good at doing it is because there are all these bookkeepers and accountants out there who say, oh, you need to give the money to us to do it. But between you and I, my experience is many bookkeepers and accountants make horrendous mistakes when they're looking after the accounts of a social enterprise. And because the social entrepreneurs don't feel confident in challenging those accountants and bookkeepers, say, can you just explain? Can we make sure we've got this right? We get into all sorts of problems. But you are better at doing accounts and budgeting than you think you are. It's just maths was really horrendous at school for most of us. For most of us, we've never had to use long division, simultaneous equations, algebra, and such like it since we finished our maths exams. But because we struggled with them, we felt we couldn't do maths. The good news is you can. It's just a mindset trick. And hopefully working through this tutorial and the materials will help you regain that confidence and understand that financing doesn't have to be that hard. We can work through it. And there's lots of prompts and materials and exercises that you can link to as you work through it too.